I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for listening to our Following the Money podcast. We did not produce a Following the Money podcast last week because I was in New York City speaking at the CMT Association's 50th Annual Symposium. Some of what I would consider the smartest people that I know in this business, after being in the business for a long time, were there. Much of the conversation was about current market conditions, what's going on in the markets right now, and all of the people that I wanted to seek their opinion to see what they thought of conditions basically were on the same page with us, and that the technical and quantitative conditions of the market were some of the most unusual of their careers. And it all indicated one thing: it's market indecision. The market doesn't know what to do here. The collective wisdom of the market has basically been locked up since the very end of last year, right around the holidays. It stays that way right now. What I can tell you is when I've seen periods of indecision before, it kind of it captures that energy over the course of months, and it eventually becomes a springboard for a new trend. Today I'm going to be talking about what our latest analysis and data-driven models are saying about the latest financial market conditions. That is, when to be on offense and looking for opportunities, and when to be playing defense and protecting your capital. Today is Sunday, May 7th, 2023. Let's follow the money. Trend and tactical signals. The benchmark S&P 500 has essentially been drifting sideways since December of last year, between 4,200 up top and 3,800 underneath. So you got that 400 index points, and we've been running up and down there sideways. So there is no current trend. The index closed at the end of last week at 4136, a little bit below that 4,200 level. The sideways behavior clearly indicates that the market is uncertain on how to react to current market conditions, which include fear of inflation, uncertainty coming from the Federal Reserve regarding the direction of interest rates, fear of another potential banking crisis, and fear that Congress will default on its U.S. sovereign debt. We're set to run out of money here in the U.S. Over the next several weeks, and that really needs to be resolved quickly, or I think it's going to cause some problems for the market. Looking at volatility, however, the VIX has stayed pretty low. The reason the VIX is low, even though there's all of these cross currents in the market, is because I think the market feels comfortable as long as the S&P 500 stays in that 400-point range between 4,200 and 3,800. It would take a sustained rise above 20 in the VIX to indicate the market has become fearful. If that happens, I think we see another decline from 4,200 and maybe move back towards that 3,800 level, which was the lows really of the past 5 or 6 months. The opposite is true. The longer that the VIX can stay underneath 20, the more it indicates the market is calm, and the more we're going to see at least these short-term rallies like we saw at the end of last week. In terms of market sectors, our SEAF model, SEAF is an acronym. It stands for Sector ETF Asset Flows. It continues to corroborate what we're seeing in the broad market. We're seeing a lot of sector rotation. We're seeing the market very quickly moving from offensive sectors like technology, consumer discretionary, communication services, to defensive sectors like consumer staples and utilities. We're seeing that back and forth. The normal trend of our SEAF model is typically 7 to 8 weeks. That is, we'll see the money move into one of those sectors and it'll stay there for around 2 months. So far this year, it's been 2 to 3 weeks. Why is that? It's because the market isn't sure if it's on offense or on defense here. So knowing that the market is really confused here, it's very nervous, it doesn't know where to go. It's not the greatest answer for us, but it does give us some valuable information. And again, I think that information is you don't make a lot of directional bets right now until this situation clears up. In terms of relative performance, while the S&P 500 has been drifting sideways since the beginning of the year, our CARP model, CARP is another acronym, it stands for Cross Asset Relative Performance. That model has identified some very good relative trades over the past 6 months or so. Growth, IWF is the ETF, has outperformed the S&P 500 by 5.2% since January the 26th. Technology, we're looking at QQQ for the ETF, has outperformed SPY by 9.9% since January the 20th. And large cap, SPY again, has outperformed small cap, IWM, by 9.6% since March the 9th. So even though the broad market is back and forth sideways with really no discernible trend, there is some relative performance opportunities out there, and our CARP model is able to capture several of those. Finally, internationally, our U.S. versus the world model has identified several very profitable relative outperformance trends in Italy. ETF for that is EWI, France, EWQ, and Mexico, EWW, which have outperformed SPY by between 26 and 27.5% since September, October of last year. The model has also identified some new overweights overseas that subscribers can get by going to the Research Center. If you go to the Research Center and you go to the U.S. versus the world model, those are listed. When the broad market is moving sideways, we start to look at relative trades so we can see if we can make some money and dance in between the raindrops while the bigger market is trying to figure out direction. So that concludes this week's podcast. Thanks for listening. If you liked our Follow the Money podcast, you can subscribe to it free of charge via the Asbury Research YouTube channel. More information about Asbury Research, including our data-driven models, is available at asburyresearch.com. Have a profitable week, and we'll see you 2 weeks from today.